It's obvious by now that the Australian housing market is in a bubble. Aussie homes have become some of the least affordable in the world, and prices have pulled further away from what ordinary incomes can afford, which led to the Reserve Bank hiking interest rates 3 times this year. Yet the crash everyone kept waiting for still hasn't turned up. So the bears were wrong. Expensive doesn't necessarily burst a housing bubble. And right now, I think people are making that exact same mistake again. They're looking at the house price chart when they should be looking at the person trying to get the loan. So if you own a home, sitting on a deposit, or carrying an investment property, the next 12 to 18 months decide which side of this you end up on. Today, I want to walk you through 4 things. First, why unaffordable housing never bursts a bubble and what actually does. Second, the credit story that reversed in Australia this year. Then, why investors walk away from established properties before the tax change started. And finally, how all of this lines up almost perfectly with the 18-year property cycle. Before we get into things, you need to know this. There is a distinction between knowing a market is expensive and knowing where you sit inside the cycle. Knowing where you sit is what protects your wealth the most. I break this down in my free 18-year cycle workshop. I'll go through the historical records, why these booms and busts keep repeating in the same order, and where I believe we are right now. Then I'll look at what I'm watching as we move into the next stage of the cycle. It's free. There's a link at the top of the description and in the pinned comment. Once you've got this framework in your head, what's happening in Australia right now becomes a lot clearer to see and a little bit more interesting. So back to the buyers. A house price is not set by how many people want the house. It's set by one transaction between one seller and one buyer. Pretty straightforward. That buyer needs a bank to say yes. Economists call this effective demand. In plain English, it's demand with money behind it. 10 families can want a $1.5 million place in Sydney, but if the best qualified person can only borrow enough to get to 1.3 million, that house doesn't sell for 1.5. It sells for what the buyer can finance. And that one sale becomes the comparable that the valuer uses on the next house down the street. Credit is the variable that sets the price. Let's look at what happened to borrowing power this year. Australian Central Bank, the RBA, has raised the national interest rate 3 times this year. That was in February, March, and May, which brings it up to 4.35%, and it's held there since June. Borrowing power means the maximum amount of a bank will lend you, and banks don't work it out using real mortgage rates. The banking regulator, the APRA, makes every bank add 3% on top of it, and they check your income could still cover the repayments at that higher rate. So if the mortgage rate's 6%, the bank tests you at 9%. If your wage can't handle repayments at 9%, they shrink your loan until it can, which means every time the national rate rises, the maximum you can borrow falls. Bank economists say this year's rate hikes cut around 7% off what a median income household can borrow. That's more than $53,000 of buying power gone. And your family's already holding the average mortgage of $735,000. Repayments are up over $350 a month. Nothing about these families changed. They have the same job and income. The bank just writes them a smaller check every month. So the obvious question is, who's supposed to fix that? For most of the last 2 decades, the answer was always the same. It was the Reserve Bank. It cuts interest rates, borrowing power goes back up, and buyers come back, prices recover. But that door seems to have closed at this stage. Headline inflation was 3.8% in the year to June, and the RBA's August statement doesn't have inflation back in the acceptable band until late 2027 at the very earliest. So Governor Bullock's team said a cut wasn't even discussed at the August meeting, and that more hikes can't be ruled out. So no rescue is arriving this year. Then there's the second crack. For years, property investors bought every extra home that hit the market. That buyer has also left the room. At May budget, the government rewrote how investment properties get taxed, with the new rules starting on 1st of July. 2 tax breaks are changing. The first, negative gearing. Right now, if your rental property loses money, meaning the costs are bigger than the rent coming in, you get to knock that loss off your tax on your salary. Under the new rules, that deal only exists if you buy a new build. The second is the capital gains discount. Today, when an investor sells a property for a profit, they only pay tax on half of that profit. The new rules shrink that discount, which increases the tax bill. Over 3.3 million investors are losing their tax breaks. The policy is almost a year away, and investor demand has already collapsed. Investor mortgage applications are down 28% at CBA and 26% at Westpac. Equifax, the company that tracks the credit applications, watched mortgage demand swing from 3.7% growth before the announcement to a 12.5% decline after it, meaning lending on existing homes fell nearly 15%. Lending on new builds hit a record high. The investor money is crowding into new builds now because new builds keep the tax break. And that matters for every homeowner because at an auction, the final price is set by the last person bidding. For 20 years, the last bidder was usually an investor. That bidder is officially gone. Which brings us to the auctions themselves. The auction clearance rate is the share of the homes that sell on auction day. When it's high, buyers are fighting each other for houses. When it's low, sellers are standing there with nobody bidding. Across the capital cities, the clearance rate peaked around 66% in February, and by late June it had fallen to 42% and it stayed below 50% for most of winter. By mid-August it recovered to 56.5%. That bounce matters and I'll come back to it in just a sec, but look at what created the bounce. Sellers dropped their asking prices until buyers showed up. The buyers hold the power now. So if you're looking for a property, now might not be a bad time, but you've got to pick your areas correctly. You can see that same shift in the number of home sales. Total listings are up almost 23% in a year, with Brisbane up 36% and Perth up 31%. Meanwhile, the number of homes actually selling is down 16%, and new listings slowed in July, down 11% nationally. So the pile of unsold homes is growing because houses aren't selling, and the sellers who give up are renting them out and waiting for spring. Those homes will all come back onto the market. Maximum pain is being delayed until then. Only now have prices started to respond. National values are down 1.9% in 3 months, and the 5 biggest capital cities are down 3.2% from their peak. Even regional Australia just had its first fall since January 2023. Most people see falling prices and think the bubble is bursting right now. In reality, the financing underneath the market broke 6 months earlier, and the price chart is the last place the damage shows up. So let's put the pieces together. Rate hikes into a housing shortage, a tax change removing the investors, and prices are sliding while rents are staying relatively tight. They only click into place when you see the rhythm running underneath them. Real estate moves in roughly 18-year cycles, 14 years up, 4 down. Fred Harrison mapped it out in the UK and Phil Anderson refined it using the US land sale data going back more than 2 centuries. That framework has let Harrison call the 2008 crash years before it landed. The last major bottom was around 2011 to 2012, so we count 14 years up and we arrive roughly around now, 2026. That final stretch, that's the boom, that's the winner's curse phase. It's the phase where the last buyers pay the highest price with the thinnest deposits at the worst possible moment. And look at what that phase actually looks like based on the data we went through. Credit coming out of the system through 3 hikes, the tax shelter for the marginal bidder switched off, listings climbing while transactions fall, and we have excuses. Every cycle top came with a story explaining why it couldn't turn. In 1929, it was the permanent prosperity. In 2007, we had the Great Moderation. In 2026, it's a story of the housing shortage. Now, that thing that decides whether this stays a correction or becomes something worse isn't the prices. It usually is jobs. Unemployment's 4.4% and it's barely moved. Participation hit 67% in June and the economy added 76,000 jobs that month. That labor market is holding this whole thing up because a household can carry an expensive mortgage. We don't like it, but it can do it. When there's predictable income, that's how it does it. But underneath that, this is Roy Morgan research, 30% of owner-occupier mortgage holders classed at a risky level. That's around 1.6 million people and it's the highest since the GFC. So the surface looks fine and the foundation is basically stretched. So let's take a look at it here because I'm not trying to sell you the doom side of things. The shortage is obviously real. We've seen it, we've got the numbers. Australia needs like 250,000 homes every year until we get to that final date. They commenced at only 197,000 to the year ending in March. The banks are well capitalized at this point. Homeowners aren't being forced out in bulk. They're just refusing to sell. And Perth, Brisbane, Adelaide, they built up enough equity over the last boom to absorb a serious fall without wiping out 5 years of gains. What I'm trying to say is I've been early before. I'll be early again and I'm not your financial advisor. I think you guys know that by now. But I'd rather be a bit early than completely caught out, especially when the asset in question is the one you live in. When you weigh it up, the negatives outnumber the positives here. So let's recap it all, starting with signal one. That's the financing. Cash rates at 4.35%, borrowing power is down about 7%, applications down 15 to 20% at the major banks. Signal two is the investor. The investor loan values are down 10% in a single quarter. Applications are down as much as 28%, and the policy that triggered it hasn't even kicked in yet. Now we get to signal three, which is the plumbing of the whole thing. Clearance rates fell from 66% to 42% before vendors dropped their price. Listings up almost 23% and sales volumes down. Three separate forces basically pushing this thing in the same direction as the cycle suggests. This brings me back to where we started. Prices only start falling after you see stress in other markets. Here's what to do with the information. Let's start here. Okay, if you own your own home, check your repayments and see if they're comfortable for you. You'll basically be in the strongest position if there is no stress to you right now. But don't build your plan around a rate cut in 2026 because the RBA hasn't got room for one until late 2027. Instead, run this number. What do your repayments look like if the cash rate goes up again to 4.6? If you bought in the last 18 months and you're on a fixed rate that rolls over soon, this is the moment to act. Open the loan documents, find the rollover date, basically when it matures, then stress test your budget against 7% instead of 5.9%. If you get a little worried looking at that, put the difference aside every month until you have a backup of about 6 months of cash. That buffer is only the thing that's going to stand between you and getting into being a forced seller if things turn bad. And if things don't turn bad, well, then you can go on a holiday. Don't try and catch a falling knife at good auction weekends. Clearance rates have already bounced once this winter. I suspect they'll probably bounce again and everyone will try and jump on that bandwagon. But declines usually last more than 4 months, especially when they get started. This is the long-term decline. Now, what you can do is go to open homes in the suburbs you actually like, talk to the agents, look at the historical data, and have a look at how many price reductions that listing has already had. I noticed one down the street from me here has had a couple of price declines on their listings, almost 20% down on that listing. So if you're an investor carrying leverage, basically just understand what has changed. Established property lost its tax support from July 2027 and the market's already priced that, well, it's beginning to price that in. So the deal has to work on cash flow now. For all of you, there's 3 things to watch from here. Watch investor lending in the next ABS release, another double-digit fall, and the buy side keeps shrinking. Watch combined clearance rates. Consistently back above 60%, and my read is wrong. Return to that. The buyers are returning. Back under 45% and the discounting gets disorderly. Watch unemployment against the 4.4% number. If that starts to go up, the bubble will probably burst. Then run your own tests. Count how many listings are on your street, in your area, and see how many have had price cuts because the national numbers never sets your price. Those numbers will tell us whether we're right early or wrong. And if you want to go deeper on where I think we sit in the 18-year cycle, that free workshop is in the linked description and pinned comment. So I want to hear from you guys now. Do investors come back once the dust settles, or does borrowing power keep shrinking until the labor market cracks and the forced sellers finally arrive? Drop your calls in the comment section. I read every single one of those and reply to as many as I possibly can. I also cover charts, stocks, commodities, and Bitcoin over on my other channel, Jason Pizzino, and there's a link to that in the video description as well. I'll see you guys at the next video. Until then, take care and peace out.